Pleasure to meet you. Nice to meet you. So I'll let my guests introduce themselves in just a moment, but first to kick things off, this session is about new rails in financial systems, and I think that Joseph in particular from the last panel gave us a great entree into this. In the existing financial infrastructure and amongst large financial institutions today, there's a significant and growing interest in the potential for technologies like Bitcoin, like Ethereum, these math-based currencies, these decentralized protocols to radically increase internal efficiency. And so I think I'll ask us to maybe take a step back from some of the big society-level thinking that often goes on in these sorts of communities. I know that with many of the financial institutions that I deal with in my research role at the World Economic Forum, they're institutions that are forward-looking and thinking, but they need to maintain both a step in the one foot in the world of today and another in the world of tomorrow. And so they're thinking about how they can use these systems to streamline internal processes, to reduce risk, particularly of the counterparty variety for their customers, and generally resolve a whole series of pain points through simpler and more streamlined systems. And so I think that'll be a big aspect of the discussion that we have here today. So I'll throw it over first to Jason and then to Nico. Ask you please to introduce yourself, the firm that you work with, and also how you got interested in this topic.
Sure. My name is Jason Mitchell. I work at a firm called GLG Partners, which is part of Man Investments. We're one of the largest alternative asset managers in the world, meaning a lot of that is a hedge fund, but a big portion of that is long-only, conventional investment, fixed income. It effectively runs the gamut from rates, fixed income, to equities, but we don't tend to do a lot of illiquid or private equity. Within that, I co-manage our global equities long-only fund. I also manage our sustainability strategy, of which we have a couple funds that are environmentally and sustainably focused. My interest in terms of cryptocurrencies, I've known Stan for a while, frankly, and it's been interesting to see how both the hub and Venn has developed. Also, I mean, from an investment perspective, fintech is a huge theme. I can talk about that later, but within that, unfortunately, as of yet, from a public equities perspective, the future of currency is still very difficult to invest in. So it remains an area that intellectually is really exciting, but tough to watch or to actually invest in. So I'm looking forward to the day that we actually start seeing some more IPO activity in the area.
Nico?
Good morning. My name is Nick. I think it comes through as Nico for some reason on my emails, but it's neither here nor there. I think my mom still calls me that. I'm the co-founder of Blockchain, and Blockchain is the world's leading Bitcoin company. So just this week, we passed 3.25 million users. There are a couple different services we provide, but most public-facing are wallets, which are ways for people to secure and store and manage their digital currency, Bitcoin today. We also have an information site, which is used by Bloomberg and Fox and a lot of other people to study currency statistics, look at transaction histories, look at monetary velocity on the Bitcoin network. We get hundreds of millions of views to these properties every month. And at the core of our company are APIs that we've built, open sourced and released to the world. Thousands of developers have built really cool applications to interface with the Bitcoin protocol. And all these tools are free. We give it all away. So my background, I'm from Denver, Colorado, but I have a super kind of international experience. My mother's French. My father lives in South America. My sister's in Africa. So we all get along by being on our own continents. So that works for us, but we're actually a pretty close family. But I think, when people talk about the millennial generation, I feel like I'm one of those guys. I'm a millennial. And there was some research that came out last week from Goldman Sachs that said that 33% of millennials don't expect to have a bank account in 5 years. And this is pretty compelling. So that's just the millennials, not including the 2.5 billion people that probably were not polled that don't have access to financial services whatsoever. And I think what we're talking about in my company a lot with Blockchain is how are we going to build financial services for these people and for the future? And I think we get an opportunity to completely reimagine how the world transacts. And that's incredibly exciting. Decentralized systems and the Bitcoin network and blockchain technologies are going to be enormously impactful in the world. And hopefully we'll get to explore some of these things soon in our conversation here. But anyway, I'm looking forward to sharing what I've been seeing. The last year, I flew 300,000 miles around the world. I've been to just about every place you can imagine, meeting with people that are doing development work, going to hackathons, community engagement, speaking with regulators and three-letter agencies, and anyone that would listen about why this technology is so transformative. And to misjudge or misunderstand the magnitude of this would be incredibly ignorant. So I'm hopeful that I can communicate some of these ideas with everyone today.
Great. So Jason, you work with what could arguably be called a traditional financial institution, an alternative investor perhaps, but a traditional one nonetheless. Can you talk a little bit about some of the use cases that you see for these sort of protocols within your own business, and what preconditions really need to be in place in order for you to effectively leverage those?
Sure. I mean, conceptually, it makes sense to roll this out. In fact, I was having some conversations with some of the people that run our back offices. And you look at the technology, it's traceable, it's audible, and it's transparent. I mean, and so those are three important ticks. The problems and these preconditions, there are many, unfortunately, and it's still early, and I'm speaking from an institutional perspective. First, there's the money laundering issue. The conspiracist would say that this is the sort of the issue that a lot of central banks are using to slow the rollout. Whatever your view is, it is a huge regulatory hurdle for anything we do outside of this, and even including how we interact with our clients now in this sort of post-Lehman, post-Great Recession crisis to prevent things like this. And it has big implications, certainly in the new formats of funds that we roll out. And I'm not talking about just hedge funds, but even long-only funds. In Europe, UCITS funds, these are highly regulated, highly transparent funds that were rolled out post-08, have become incredibly popular. It's what we tend to run on. And these UCITS funds run by strict investment charters, specifically around liquidity. So what you're doing, if an investor, retail or institutional, invests in this, you are guaranteeing that person that they can redeem either within a overnight basis, a weekly basis, or a 3-day basis. But there's a recognition that in the past, funds tended to get sloppy, let's say, and suddenly invest in things that were not liquid and prevent people from taking out their money, from redeeming. And so there's been this spate of regulation that as a positive has protected the consumer, but it tends to make new technologies like digital currencies, integrating that, much more difficult. But one positive, and it's very prominent on the long-only side, not the hedge fund side in our business. Whereas when you think on the hedge fund side, think about an absolute return model where investors are less sensitive about the fees they pay. On the long-only side, if that makes sense, like mutual funds, there are a lot more of them. There are these countervailing trends, passive investing, meaning there are these systematic funds that come in at very low cost that active investors like myself have to compete against. And what it means is there is a lot of fee convergence on that side of the business. Again, that's great for institutional investors, for retail investors. To give you a sense, institutional investors typically around 75 basis points on that. Years ago, it was, could be as much as 2%. And in the period that we are right now, when half of the Eurozone, more than half, is sitting at deflation, when you are paying money to buy short-dated bonds, bunds, any kind of return is paramount, is really important. And so using technology to reduce fees, to reduce this friction is really important. The people that, managers that integrate it faster are advantaged. One other big blocking point, actually two though. One is the lack of a derivatives market. I mean a really, really deep one. Earlier we talked about China and how long it's taken for them to open their capital account they're still obviously in the process of doing that and developing a deep domestic bond market like the US. Europe doesn't really even have one as deep, which is why the ECB quantitative easing is going to run into some issues. But having a derivatives market allows investors or managers to hedge out this currency risk. So if someone basically has dollars, wants to, or euros, let's say, and wants to buy a Bitcoin fund, there is there's a Bitcoin euro risk that they're making. As a manager, according to my mandate, I've got to figure out how to hedge out that risk. And right now, the only answer is to find someone out there who's very bearish on Bitcoin currency, who will take that offsetting risk because it's not deep enough, it's not liquid enough. And the only other thing I don't want to get too on is the big hurdle, I think, is custodians in this whole battle, and not small regional custodians like Elliptic is doing, is one in Britain. But I mean the big global custodians that names like State Street, names like Boney Mellon. I mean, each of these have about 30 trillion of assets, and that's about 30% of total equity assets out there. It's a massive amount, and they move on big numbers. And still, I think that digital currency represents such a small amount that they're not really focused on revamping a lot of their back-end infrastructure. That'll happen, but it's taking some time.
Thanks, Jason. I think so raised some really interesting issues there. I'd like to go into some of them a little bit later, like the derivatives markets and custodians. But first, Nick, I'd like to ask you, early in his comments, Jason talked about what I think are some really severe problems that Bitcoin has with public relations in the broader market. The reality is that a lot more people on the street have heard about Mt. Gox or about Silk Road than have read the Satoshi white paper. And I suspect that may find its way even into the chambers of some regulatory authorities. So I'm interested, when you're interacting with these financial institutions, when you're interacting with regulatory authorities, what are the most significant misperceptions or failures to understand that you're encountering, and how are you addressing them?
That's a really fantastic question. So it's hard to pause once in a while and reflect on how much progress has been made, I think, in the public perception. So I talk about Bitcoin pretty much 24/7, 365 days a year to anybody and everybody that'll listen, from my cab drivers to the coffee shop people to the Paul who makes my sandwiches next to the office. And I would say that anecdotally, a year ago, 9 out of 10 people I spoke to about this had never heard about Bitcoin whatsoever. So they got maybe a 30-minute lecture if they were able to give me some time. And now I would say that 9 out of 10 people, especially in New York or London, Paris, Tokyo, they've heard about Bitcoin, but they've heard the wrong things. It's been scary, it's been intimidating, it's had a massive PR problem. And that's okay though. We're still getting opportunities to correct those perceptions. And a lot of it had to do with coming out of the shadows a bit. Bitcoin was started off by really incredible technologists. And sometimes those aren't always the right people to communicate to the next audience. And so as more folks come off the benches from consumer industries, from retail experiences, from insurance, from finance, and get interested and invested in Bitcoin, not with money, but I mean with their time and their experiences and their lives, they get to draw from those and communicate to more and more people. So in short, I think we're making progress there. I think the biggest misconceptions are that Bitcoin is somehow illegal, which is totally not true. That maybe that it's only used for bad things, and that's a really fun topic, of course. The anti-money laundering stuff comes up all the time. How do you address those issues, especially when you've got services that have custodial relationships with the money, and then you've got services that are completely open source where there's a non-custodial relationship between the software that someone's using and the money. This is a huge deal, and it's not an easy one to sort of focus on, especially from a regulatory perspective. So, on the tool set thing, we all use tools like Google every day, and I could use Google Maps to plan a camping trip with my friends, or if we wanted to conspire, we could maybe plan a bank robbery with it. And does it Google's job to figure out how you're going to use that tool? And I think in general, we believe and hope that empowering people to make good choices and having freedom of choice is generally better than systems that coerce and hurt people. So in that sense, it involves a lot of tough conversations, but you need to remind people that Bitcoin is completely open source. It has no restrictions in that sense. Anyone can participate. It doesn't discriminate. It's based on mathematics, and it's not going away. It's a financial protocol for the internet, and we've made huge progress. I mean, the number of transactions that are happening on the Bitcoin network grow week over week, every single week. We add about 40,000 users onto our wallets every single week. Last week, 250,000 transactions were done through blockchain wallets in the neighborhood of around $200 million. This is peer-to-peer transactions, though. All of that transacting cost those people maybe $6 total. So like the cost of transactions is going to drive practically to zero. And this is something that is going to massively impact how financial services think about where they make their monies.
So Jason, you talked a little bit about use cases for decentralized networks within the investment management space. And part of the work that you do in your investing day-to-day job involves investing in financial services institutions. I know that GHG has a moderately sized position in Visa, that it's grown over the last few years. Are you bullish on the ability of these financial institutions to incorporate these technologies and to potentially transition from, in the case of payment processors, the current centralized paradigm to being valuable in a world that's distributed and in which the toll-taking opportunities are much lower than they are today?
Yeah, the one thing, I cannot actually make recommendations or talk specifically about stocks.
Of course.
But I mean, I can broadly say, why the market likes the processors is because you're seeing transaction growth at double-digit, sort of low teens growth. I mean, that is 2x the loan growth in the U.S. Loan growth is around 4 or 5%. That is 3 times global GDP. There's a lot of growth in loan growth. And so when we, so let's take a step back for a second. This is the future of money, a digital money forum within the context of fintech. Fintech is incredibly broad, and when you look at when you try and weight the themes, digital money versus mobile transactions. I mean, there is a huge. So I guess the point I'm trying to make is that the idea around mobile transactions is driving the theme around these processors right now much more than digital money. You can definitely make the case that, and Europe is actually, from a regulatory perspective, sort of come in and cut interchange. You can make the case that they are making uneconomic rents. When you look at the artifact of what interchange is, I don't know if many people know what it is, but the 2% fees that you're paying on credit cards, it's an artifact of the knuckle busters. Yeah, I don't know. Maybe I'm too old, actually. I'm not a millennial. But when you used to pay for a credit card, you'd knuckle bust. You'd do that with a carbon copy, and you'd had 3 or 4 pieces of paper. Those were sent to a center, and there was huge costs associated to this back office that was processing all of that. There was a lot of potential fraud or loss, and that cost, unfortunately, has persisted, or not the cost, but the rent has persisted and the cost has vanished. And that's why these processors are making, you could call them uneconomic rents. But the investment case, the market would say, is that because you've got this uneconomic rent, it's certainly a lot lower in Europe now, but a lot higher in the US. You've got strong transaction growth, very high margins. At the end of the day, you have earnings growing 20-25%, fairly reasonably, kind of valued company, trading at 20-25 times earnings, for something that has deep moats around mobile. And the idea of decentralized versus centralized, you could also make the case that, when you look at fintech from a public markets perspective, you start upstream, and it all begins with unfortunately or fortunately, with MasterCard and Visa with very deep moats. And then as you go further and further downstream past eBay/PayPal into downstream, you get lower moats, and it becomes less clear who the eventual winners are on a multi-year basis. But for the next 3 to 5 years, if you believe that mobile transactions will continue to outgrow the market, then it's hard not to say that Visa or MasterCard aren't advantaged from that perspective.
And so, Nico, I'm interested in your response to that and your view on the potential of networks like Bitcoin to supplant the current centralized networks. Because my understanding is that today, the Bitcoin network isn't capable of handling the type of load of transactions that a MasterCard or a Visa card network would. What gives you the faith that you have that it can scale to really serve these type of industrial applications?
Yeah, that's an excellent point. So I try and remind people of this too, which is that if the entire history of Bitcoin was a clock, we're in like second 2 or 3. It's super early on still. And the neat part about it though is that we are experiencing strong scale and growth, and it's been able to manage that acceleration. However, there are, at the time being, if we were to triple in size, we would start to see latency on the network. And so actually, just 2 days ago here in London, the Bitcoin Foundation, as well as Blockchain, sponsored an event called DevCore. And a lot of the core developers that work on the Bitcoin protocol came here to discuss this. And the consensus was, and led by Gavin, who is the chief scientist for the Bitcoin Foundation, that we need a bigger chain. And what he means by that is we need to be able to stuff more transactions into the blockchain every 10 minutes. And so Bitcoin is a learning protocol. It can be improved, just like applications on your phone get updated. And so when we need to make enhancements or adjustments, it's possible. And those things need to happen in a thoughtful and timely way. They need to be tested. There's billions of dollars at stake here just now, and this doesn't include all the opportunity in the future. So it's not about moving fast anymore. It's about moving carefully. But I'm totally confident that the Bitcoin network will be able to scale. It's already demonstrated that it can. So I'm not worried about that.
One more question that I'll ask to both of you, and then we'll turn it over to some questions from the audience. Jason, you identified some needs for the use of this on an industrial level, particularly with the investment management. And two of those that I heard were the need for some type of derivative formation, as well as the need for a better level of custodial services. And so I'm interested where we've heard, I'm hearing more and more about Ethereum and other sort of Bitcoin 2.0 solutions, increased programmability, and sort of more functionality. Do you feel there's the potential for this new wave of technologies to serve some of those functions? Or is it really about, we have to convince State Street that they want to get involved in this?
I think, number one, on the custodial side, it's already happening. I mean, a company like Elliptic, you're seeing it regionally in a small scale. It's just not happening cross-border on a large scale. The big global custodians are really slow. And, from their perspective, they should be. Just because the absolute amount of money outweighs, sort of the immediate need for building some architecture around digital money. But I do think it's happening. What was the other question?
Oh, sorry, the potential for Bitcoin 2.0 protocols like Ethereum to offer some of this functionality, either in the custodial sense or perhaps more likely in terms of offering derivative functionality via smart contracts.
Yeah, I don't have an answer. I would actually be curious if anyone has a view on the derivative side. Again, I'm sort of looking at it from a hedging perspective. And when we talk about, at my firm, and again, when you think about finance, finance tends to feel very slow and inefficient and lack innovation. Finance is obviously sort of big, and there are a lot of facets to it. At my firm, we tend to develop and look at new products a lot. And so this is always a discussion point. And if there's something that we can develop and create into a really interesting, unique product, we're very entrepreneurial from that perspective. But this question of how we manage the risk in this environment where everyone it's a big issue right now to run market neutral, very hedged, and watch your risk. to give you an example, the Swiss National Bank and the fact that they revalued the currency was a big, big shock for the industry. And it wasn't in anyone's VAR models because people were taking the central bank basically at its word from a carry trade perspective. That created some blow-ups across the industry. Not enormous, but certainly it created some shockwaves. So, when you think about the volatility with VEN as a currency, do you treat it as a currency? Do you treat it as a commodity? How do you hedge it? It's still unanswered. But if anyone has
I've got
views.
kind of a cool story to share. So last fall at Money 2020, which is a big event maybe some of you go to in Las Vegas, it's kind of one of the bigger fintech conversations that happens annually. There was a hackathon that was sponsored, and all the big payment guys were there. So Visa and Amex and PayPal and Venmo and Braintree, and then Blockchain and a couple other companies also sponsored things. And so it was a big hackathon. Hundreds of thousands of dollars were at stake for these developers to build things, and they could and were incentivized to pick multiple partners to work with in order to move up through the competition. But almost 50 or 55% chose to do Bitcoin-related projects because they wanted to learn more and spend time on that. And as they were going through the finalists, I was watching this young man on stage, and his dad was taking pictures of him, and he's talking about this project he lit up and wrote in 24 hours. So in 24 hours, this kid wrote a program that allowed a consumer to pick a risk tolerance on their Bitcoin wallet, red, yellow, green. And green would lock 99% of the value of their Bitcoins to US dollars, red would be 70, and yellow was something else. And so in 24 hours, this kid built a program that would basically eliminate the risk for a holder of Bitcoins instantly. And so I was watching him, and I talked to his dad, and I said, man, your kid needs to drop out of college and go make millions of dollars. And he was like, my kid needs to graduate from high school. He was 16. He had to get parental consent just to go do this. So when you talk about the speed at which the developers are moving and when they're spending their time, that's where the puck is going. And so just kind of let that sink in, I guess. But there are definitely going to be ways to do leveraging and risk in Bitcoin. It's already happening. Derivatives markets will come online this year, and there are 2 ETFs that will be publicly traded within the next 6 months. So there'll be ways for retail and institutional investors to get exposure to Bitcoin without having to be so concerned about the custodial side of it. And then if you want to stuff cash under your mattress, you can do that as well. With digital currency, it's the same way. So,
Fantastic.
anyway.
All right, so we'll throw it open to a few questions before wrapping up. Right out there in the back.
That's a question for Nico. I'm the chairman of the CSI FinTech Forum, so I speak to quite a few financial institutions, banks, asset fund managers, reps all the time, also about Bitcoin. Now, when I mention Bitcoin, you can kind of see their scare in their face. However, when you talk about blockchain technology, they all get hyped up and excited. So my question for Nico would be, particularly with banks, financial institutions perspective, what do you think are the top 5 applications for blockchain technology for banks other than just currency transfers?
Yeah, that's a good one. So I'll address it in 2 ways. First is to talk a little bit about a misconception I think that's constantly perpetuated right now, which is that banks and financial services seem to think that they love the idea of blockchain or the blockchain, but they don't realize that it doesn't happen without Bitcoin. If you don't have a credit system and a way to incentivize people to secure the network, then it does not happen. And so you can't create a blockchain and invent that without people creating network effects to create more security on the network. So I think it's kind of funny that they think they can have all the advantages of a distributed network with 0 fees and all these things without a digital currency, and that's not the case. So anyway, that aside, the top 5 applications other than the most amazing one, which is the ability to transfer value anywhere in the world instantly, basically for free with anybody, which is a really big one, by the way. But the other 5 that might be interesting and things that I'm excited about, and some of the guys are working on this at Ethereum and other projects, and they'll be able to do it with side chains on the Bitcoin protocol, are things like distributed storage, which I think is pretty cool. Today, that's all centralized with Dropbox or Google Drive or things like that. But I think it'll drive the cost of storage way, way low. I mean, imagine if I could rent a terabyte hard drive out or lease mine in my home and earn some income off that, small amounts of money. I think that'll be exciting. So distributed storage is pretty cool. Smart contracts are kind of an obvious one. Proof of creative work is an interesting one. So if I'm an artist and I make music or write books, I could actually digitally stamp my progress and demonstrate cryptographically that I started doing something before anybody else did, so that when I have a conflict in the future about a creative work I've done, I'll be able to show without a shadow of a doubt that I started working on something. And Factum is a project that's going to be able to do that. I'm only just at 3 here. Lending, peer-to-peer lending, I think is going to be huge. I think people building networks and sharing with each other and creating liquidity pools in a decentralized way. And the last one will be crowdfunding for sure. Right now, if I wanted to invest in my friend's pizza place, I may not be able to if I'm not an accredited investor. And that's really sad. The people I know that I want to invest in are my best friends and family members, and I may not be able to actually help them grow their businesses. So in terms of like the ability to unleash entrepreneurial capital, which is a huge deal, you're talking about millions and millions of jobs, I think crowdfunding with digital currencies is going to be off the chain.
Great. So we'll take one more question, and then we'll wrap up. The gentleman in the back there.
Hi, how you doing? Is this on? Can you hear me up there? Yeah.
Yeah.
Preston Byrne from Eris Industries. This whole blockchain without Bitcoin is a meme line we're hearing from Bitcoin is actually completely wrong because we built it. And so when you, and this actually kind of goes to addressing the derivatives point, when you look at it as just a database, you then have various different security strategies which you implement in order to secure that database. In the event that you don't have someone in control of the database, you need to have an economic model such as Bitcoin's, which rewards validators to add blocks to the end of the chain. If, however, in a commercial context, which is where where every bank is going to be using them, you will have an administrator of that chain, and you will have permission validators which that bank controls. And then people go, well, why not use a SQL database? And the question is, well, a blockchain is a distributed rulebook which carries out a function very predictably. In the case of Bitcoin, that's a clearing and settlement function which is automated. There are costs built in, but the actual process of clearing and settlement is highly predictable. So just to the derivatives point, you can structure databases which, blockchains are databases and protocols. The database is the history of a particular chain. The protocol is the set of rules on which it operates. If you have two protocols which are common, then they can be interoperable within the financial system. So just to clear up that misconception, this is actually possible, and what do you think now that it is?
So is there a question?
Yes.
Does your What's my opinion about that? That's great.
Does your response now change?
My response is that I'm always learning too. So the accurate thing there is that just because human beings invented nuclear power 50 years ago doesn't mean we aren't still using coal-burning power plants. Yeah. And there are going to be incredible innovations. There'll be teams that come up with ways of doing things differently. And we're going to see the market will get to choose what works best and what people trust. And that'll be a big deal. And so we already have millions of people around the world trusting and using Bitcoin every day. And I'm excited about that. And I'm sure there'll be other innovations that are compelling.
Great. So that wasn't a question. And so I am going to take one more question before we wrap up. The gentleman there.
So this is a question about long-term economic stability and the idea of decentralizing everything, taking away the control that you currently have with money supply, with lending, with the ability to essentially put a stop on a bubble and to be able to ease out a bust. If you completely take that away, what's to stop a bubble perpetuating for a lot longer or a bust for being much more painful because you no longer have control in the same way that you currently do?
You want to start
Jason?
off?
You go first.
It probably went sort of counter to what most people think in here. I'm more sympathetic to central bank action right now. I mean, when I look at let's say Bitcoin and sort of the algorithm around there, when you are no longer creating money in that kind of world, and you have a lot of other growth in other areas, what does it mean for wage growth? What does it mean for inflation, good inflation, not bad inflation, or deflation, particularly in a time where, again, like I said, half of Europe is in deflation. The U.S., energy is obviously weighing on inflation in a huge way, is in disinflation. When inflation is a huge problem, can you opportunistically, and you've got to obviously have a lot of trust, and a lot of people don't like that idea, but have a lot of trust in central banks to reflate economies. I look at the U.S. and opponents of that a couple years ago said, well, we'd have runaway inflation. We don't. Even take out energy. and headline CPI, X energy in the U.S. is running probably 1.8 to 2%. That's actually fairly stable and good for the economy. And we've gone through a period where the Fed's balance sheet's gone from about 900 billion to 4 trillion. I mean, it's a frightening asymptote that you look at on the graph. But we finished tapering, and we're at a point where rates should, be going higher, and we need to normalize the cost of capital, and that cycle is ending. I guess I'm more sympathetic to the fact that there are cycles, or business cycles, or economic cycles, whatever you call them, and you need a Keynesian sort of offset during those down cycles. You've got to have a lot of trust in that. From an algorithmic cryptocurrency perspective, I worry that there is, the euro's been a great example, right? Where you've had policy set for all of the EU. It's disproportionately helped certain economies. It's hurt other economies that have been more inflationary. Italy, the periphery, right? And it's taken arguably too long for suddenly the ECB to have to react and try to ease or find a better equilibrium. Can you, is that in peril when you don't have that activist central bank? I worry about that, yes.
So I see we're running up against time here. Nick, do you want to just add 60 seconds
Yeah,
there?
60 seconds to that, I guess. I don't have a crystal ball, so I'm not sure exactly what would happen. But I would say that probably when the kind of bubbles that we have now get blown up, the consequences are so cataclysmic, it's almost impossible to think about them. When you invent all this money, and I can tell you that most of my friends don't see better wages. It's just more and more money going somewhere into incredible bubbles, education bubbles, housing bubbles, new fintech bubbles, all kinds of things. And when those come crashing down, or if they do, it's going to be way harder than it would be in a system where the monetary supply is predictable and there isn't political issues and there aren't people trying to concentrate that wealth, I guess. So I don't know, those are some thoughts about it.
Great. I'd like to thank both of my panelists. I think it's been a really interesting discussion, and I'll hand things over to Stan.